So I have started recording. So in the last couple of videos, we have discussed about, we've been discussing about the financial functions. So under that, we discuss two applications. One is from the management accounting application. So what you had learned in your second year. So it is about the investment appraisal. So relating to the investment appraisal, we have discussed two important financial functions, that is called the NPV and the internal rate of return. And thereafter, we have taken another application that is from the financial management. Again, what you had learned during your second year, it is about the loan amortization schedule. So the loan amortization related functions we have discussed, especially how to compute the interest, so how to compute the installment of a loan that you may have obtained. So that's what we had discussed in the last class. Then when it comes to the NPV, that is quite something that you are quite familiar. So first we have started the discussion on the NPV with regular cash flows. So that is the scenario that you are familiar the most. So the regular cash flows, in the sense that we assume the cash flows occur either at the beginning of a period or it may be at the end of the period. So most of the time, most of the cash flows may occur at the end of the reporting period. So that's what we assume. But that may be a little different from the reality, but so it is a well-known assumption that we may use in the investment appraisal. And when it comes to the syntax of this NPV, you had to identify two most important things. One is about the rate, and that is nothing but the discount rate. Thereafter, you have to take the values. So you can go up to 254 arguments, but normally how we do, so we may select all the cash flows at once. Then thereafter, we have taken on an activity, and there we used to work out this both in the manual way as well as using the NPV function. And thereafter, we come to the consensus, and there, in fact, we have seen some of the limitations that is there in the NPV function, and also I have taken you through how to overcome that. So just to show you this particular activity, so in the first activity, we have taken the cash flows. So the manual working was there. Here we have taken the cash flows, then the discounting factor was taken, relevant discounting factor, which was 15%, and the discounted cash flows was taken. Accordingly, we could have computed the NPV. Sorry, we need not to take this NPV. All what you have to do is you have to take the summation. You have to take the summation, and that will give you the NPV. And this is how we manually compute the net present value. So you take the net cash flow, and then you take the discounting factor, and thereafter the discounted net cash flow, then you can simply take the summation. So when you are doing that using the NPV, so it was quite comfortable exercise. All what you have to do, you have to identify the cash flows and the applicable discount rate. So with the help of NPV, you could compute that. So initially how we did, we have taken the NPV, and you can go to the expanded form. So it is quite convenient. So then you have identified the discount rate, so which was 15%, and then the cash flows. So when come to the cash flows, initially I have shown you selecting all the cash flows, whether we are getting into the same figure. Sorry, I haven't moved to the cash flows. So let me take the discounting factor and make it constant. And when come to the values, I have selected all the cash flows and check whether I'm getting into the same value. So you can see that that was not the case. We are getting a value which is different from the NPV that we had computed manually. So therefore, we came into the realization that this may not be the ideal way of working out the NPV. So there is an inherent limitation in this NPV function. What is that? It assumes that whatever the cash flows that you may select, those cash flows occur at the end of the period. So therefore, when you are going to use this NPV function, the inbuilt function, you have to ignore the year zero cash flow and get the rest of the cash flows and subsequently take this year zero cash flow separately, right? So in that, you would have taken this NPV again. The discount rate has to be identified. And then the values, make sure to ignore the year zero or the beginning of year one and take the rest of the cash flows. And thereafter, you can simply, you need to deduct the cash flow. Since it is in the minus form, you can add the year zero cash flow. Then you can see you are getting into the same end. You are getting into the same end. So that is how we used to apply the NPV. Right. Thereafter, we have went on to discuss a kind of a special scenario. It is in fact the reality. So how these cash flows work in reality, and we have captured this reality using the capabilities that is available in your spreadsheet package. So we call it the NPV computation for irregular cash flows. So how to compute the NPV cash flows which occurs at a different points in time. In a particular year, the cash flows can happen in different points in time. So therefore, you are bringing the reality into the model. So here, you have to select the relevant function. We call it XNPV. So it is not NPV, but it is XNPV. There also you have to give the rate, and then you need to identify all the cash flows. All the cash flows. And we call it the values. So you may select all the cash flows, and most importantly, the corresponding dates of these cash flows has also need to be selected. So that is the most crucial aspect, because you are specifying the dates on which the cash flows would occur. So accordingly, together with the values, the corresponding dates has to be given. And one more important thing, what you had witnessed here, when it comes to these cash flows, when you are arranging the cash flows, it has to be there in the ascending order. Ascending order. So you can't have cash flows without a particular order. So you need to put these cash flows in a particular order. So otherwise, it's not going to work. So that was the only criterion that you had to satisfy. And the application of this XNPV is even comfortable compared to the NPV that you had. So because the comfort comes, here you do not have to make a distinction about the year zero cash flow. There's nothing as such. You can simply go and select all the cash flows and the corresponding dates. So that was the requirement. So accordingly, we have managed to discuss an activity on that. Just to take you through that particular activity. So there you were given some cash flows together with the dates, and the underlying discount rate was given. Here also I used to work this both in the manual way as well as using the functions. And then there I have shown you the cash flows that you get, the NPV that you get using the inbuilt function. And if you had carried out that manually, the answer what you may get both coincides. Both coincides. So therefore, so we could agree that the way we have carried out this XNPV is perfectly fine. So here what you have done, you have taken this XNPV relating to the given activity. There you have the cash flows starting from 1st of January 2020 and it goes up until 1st of April 2022. So you can see that these dates are in order and the corresponding cash flows. So the rate was taken, it was 10%, the discount rate, and the values was taken. So when come to the values, you need not to make any distinction of the year 0. You may select all the cash flows. So better make it constant. And the corresponding dates has to be given. So you have selected the corresponding dates there. And you can say, okay. And see the answer what you get. It comes as 913,890. And once you work that out manually, the answer what you get is almost similar. So a negligible difference is there. So that is purely due to the rounding differences. And here we have the computation what we had done manually. And here we have the computation what we have done using the inbuilt function. You can see that it is almost equal. Very negligible difference is there, right? But when it comes to the computation of this NPV using the manual way, in the presence of irregular cash flows, that was not an easy task. So it was quite manageable if you have some regular cash flows. So there you could have easily taken the discount factor and could have computed that easily. But in the presence of irregular cash flows, the difficulty comes with the identification of the discounting factor. So when it comes to, for example, if you go to the cash flow that occurs on 1st of March 2021, you can see that from the beginning of the project, it occurs after 14 months time. It occurs after 14 months time. So therefore, when you are getting this discount factor, you have to make sure that you are getting it for 14 months. 14 months. In that particular case, what you had to do, you would have initially identified the power, and in that you would consider that 1 plus the 2 divided by 12, and that's what give you the power. So here we have the one complete year, and out of the 12 months you need 2 more months, because it's 14 months. 12 months it is 1 and another 2 months, so it's 14. So once you get that computation, it has comes as 1.16. Then you have taken the discounting factor 1 divided by 1.1 to the power 1.167. And that's how you manually establish that. So it's a definitely time-consuming task. But initially we wanted to ensure that the answer what you get using the XNPV is fine. Because in the previous instance also we have checked that and we have agreed how this NPV must be performed. So likewise, I just wanted to convince you. So when it comes to this computation of XNPV, you need not to make any distinction of the year 0 cash flow and the subsequent cash flows. So all what you have to do, just select the cash flows and the corresponding dates. So even if you do that manually, the same answer was written. So therefore you can be sure of that. And thereafter, this particular question was expanded by saying that there's another cash flow that was in between the first cash flow and the second cash flow. So here the only thing what we wanted to ensure that when you are going to take this cash flow which occurs on 10th of May 2020, as I emphasized earlier, the order must be maintained. The order must be maintained. So consequently, you have placed it in the relevant position. So you know that When it comes to 10th May 2020, it should come after 1st of January 2020 and before 1st of March 2021. So we have placed them in the correct place, then no problem, and that was what the expectation. Then you could have compute the NPV, sorry, you have to take the XNPV, that's a requirement. The cash flows are irregular. The rate has to be taken, the value should be there. And most importantly, the corresponding dates. You have given that and you have arrived at the NPV. It's 430,507. So that was about the XNPV. Thereafter, we have moved on to the discussion of IRR. The internal rate of...
Shall we ask them whether they had any questions or any kind of explanation further required?
Yes, sir, sure. Yeah. Now we believe that it's time for you to come up with the questions what you had encountered during.
Mostly it is not a very difficult thing because we have learned those things during the first year as well as the second year management accounting. So it may be not a difficult task of calculating those things, but XNPV is something new for them, right?
Yeah. Yes.
XNPV is the one of the important functions whereby we can get the irregular cash flows calculated. Once it calculated in manual manner, it is not 100% accurate because these decimals may change, right? When you're calculating that with the manual system,
yes,
it is not giving the discounting factor as we expected from the discounting tables. So we need to recalculate and get that. So that's why if they have any questions related to that area, then we can clarify that before we'll move on to the IRR.
Yes. So now it's time for you to come up with a question. So there was a request that you want to see how this if error function is applied. So we'll be coming to that after this particular discussion. Yes, there's a question that is there a specific format to state the date?
Yeah.
So when it comes to that, normally what we do that we may be taking so we can go by a particular.
It's depend on his computer date.
Yeah.
What is given in the computer. For example, if the computer date is given according to the say the month, date, and year, then we have to prepare the schedule accordingly. So that we have to check with the computer date, system date, what is given in the system. Or you can change the system date according to your vision, then you can prepare that accordingly.
Yes. Even are we able to do the same that by selecting a particular date format for this?
But if the system date is different, Roshan, sometimes it may not going to give the result.
Yes, yes. So better not to take chances.
The one is applicable to the system.
Yes.
So you need to check with the system date and accordingly you need to readjust this or they need to change the system date according to the given format.
Yes, but however, in this situation, it had worked that we have taken the date first, month, and the year.
Roshan, that's a good question.
Yes.
Now, in case of annuity is given, how to calculate the present value of the Excel. So we can show that present value formula. No?
Yes, yes, sure. The cash flow annuity, how to find the present value of that in Excel using that. Yes, Callum sir. So how do we take that the annuity factor into consideration? Is there any option that
we have a present value formula whereby we can feed that with the present value formula, or they can prepare the annuity table. They can prepare the annuity table by dividing the 1 divided by 100. The first item is 100 divided by 1. No? So that's they can prepare the annuity table by using the formula. Then they can use that, or they can go to the formula inbuilt formula called present value calculation.
Yes. Yes, here I would say that since you are doing that using the computer, the easiest way out is, so once you arrange the cash flows, so all what you have to do is the system would take care of that. Say for an example, as you are raising the concern, let's say that your cash flows would go like this. So this is period, I would take that, and the cash flows, let's say that in year 0, you invest 2 million or something, and thereafter subsequently from the project goes for 3 years. So let's say that the cash flows are annuity equal, that is 500, 500, 500. So this is all what you have to do. So if you had to compute the kind of annuity factor again, so it would take some time, I believe. So here by taking that, so simply go to the NPV and you could have select that cash flows. So give the underlying rate and take the values quickly. So therefore, this would be some efficient application. So rather than referring to that annuity factor separately, I believe, so you could do that in no time. So here we have performed that in no time. So I believe this would be the easy way out. So otherwise you may have to compute the annuity factor and then get it into the answer.
Okay, we can go to the IRR, no?
Yes, yeah. Right, good. So you are coming up with questions. So Lakshita, hope we address your issue, right? Okay, good. Fine. Next, the important function what we had discussed, it's about the IRR. So again, it will go hand in hand. This NPV and IRR would go in hand. You have discussed all the theoretical aspects related to that in depth. So while you are learning the management accounting in second year. So here you can say simply the IRR is the rate at which the present value of your investment, the NPV of your investment would become 0. Or in other words, that is simply the rate that is provided by your investment. So it is the rate, the return that is exactly generated by your investment. And also here the decision criteria. So if this IRR is greater than the cost of capital or the discounting factor, we call from a financial point of view those projects to be accepted. So if it is less than that, definitely those has to be rejected from a financial point of view. And most of the circumstances, what you would experience is that if the NPV is positive, then this IRR is higher than the discounting rate. So that is a reality. So that's why I told you this IRR and NPV would go hand in hand. So here also, first we have done it for the regular cash flows. And I would say that this was the most easiest function what we had. All what we had to do is just select the cash flows. Just select the cash flows, then the function would return the IRR. So if you wish, even you can make a guess if needed, but most of the time we are not taking that. We are just selecting the values and it would give us what is the IRR. So thereafter we have worked out one question on that. So in that situation, we have taken the cash flows, year 0 cash flow, and the subsequent cash flows was there. So if you have to compute the IRR, all what you had to do, take this IRR. So let me take that to the expanded form and just select the cash flows. You do not have to distinguish between the year 0 and subsequent cash flows. Nothing like that. Just select the cash flows. That's it. Then it will say, what is the return of that project? So this project generate 8.66. So almost 9% return is generated. So if your cost of capital or the discount rate is less than 9%, you may accept the project. So that is the decision criteria. So in order to verify yourself, even you can compute this NPV using this IRR And if this NPV becomes 0, then you know the IRR what you had obtained is perfectly correct. Then let's try that as well. To verify ourselves, you would get the NPV. The rate you can refer to the IRR. So make it constant, then the values. So make sure to ignore the year 0 cash flow and take the rest of the cash flows and thereafter adjust the year 0 cash flow separately. And once you do so, you can see that the NPV had become 0. So it confirms what we had claimed. So IRR is a return that the particular project would generate. Thereafter, we have taken that to the reality that is about dealing with the irregular cash flows. So how to compute the IRR in the presence of irregular cash flows? So all what you had to do, similar in the case of NPV, you have taken XNPV. Here you may have to take the XIRR, IRR, XIRR. So here, most importantly, the values, the cash flows has to be selected and the corresponding dates must be selected. That's all what you had to do. So then it would generate the IRR. Then just to show you the activity what we had discussed extensively. So that was the second activity. So in that, you could have compute the IRR. You may take this XIRR and give the values and the corresponding dates. Say okay. So this project generate 15.4% return. So just to verify yourself whether it is correct, all what you can do, you can take this XNPV at this particular rate, and if it is 0, then you know what you had get as the IRR is correct. So this is to verify yourself. Take the values and the corresponding dates. Yes. So you can see that it comes as 0.08 and it's almost, when you take the rounding, that is 0. So it confirms the IRR what we have taken here is perfectly fine. And that is what we have discussed about IRR. So now we may see what are the questions that you have. Yes, you say that we learned that in the management accounting that there can be occasions where there can be more than one IRR value for a single project. As an example for non-conventional cash flow projects, there can be more than single IRR value. Yes. When using Excel, does it give many IRR values for such projects or a single IRR value? So far from the experience, what I have encountered is the instances where we may get one IRR. So when it comes to these cash flows, once we compute the IRR using this XIRR function, what we had encountered so far, the one IRR. But that is something, in fact, needs to be further investigated. So having looked into that, so I can give you a proper answer. But at the moment, from the experience, what I can say that what I have experienced so far is a one IRR. But this is something still to be investigated, and thereafter I can confirm you that. Callum sir, anything to add with this respect?
Yeah, I think the question what he's asking, we will upload one video for that. I think the 2 IRR calculations, if you want to calculate 2 IRR, we have tested that with our own formula, but we can, I think I will upload one video, that YouTube video to him. Then everyone can see that if they want to apply this double IRR.
Yes. So the instances where there are more than one IRR.
Yes, there can be situation like that.
Yes, sure. So we'll be do accordingly. Good. So likewise, better bring whatever the concern that you may have. Yes, we may address all of your concern to the maximum possible. Good. Good, Lakshita. Right. So that was about the first thing that we have discussed. Thereafter, the loan amortization. So I believe that, sir, shall we go to the class activities and there we discuss this loan amortization? Kalum, sir, is it better? Since we are running out of time, we may have to look into the activities. Or are we going to summarize the loan amortization as well? Right. So since we are running out of time, so let's now look into the class activities, and in that we have one question on this, what do you call that, the loan amortization. We can have an in-depth look into that while referring to that particular question, right? Okay. Then now we may go to the class activities. So I would like to give you a chance to share your answer and we may discuss accordingly. Right. So as usual, I would like someone to volunteer. So come up with your answer and we may discuss. The class activity, question 1. So it's about the Sandaras PLC who was evaluating this investment proposal. Yeah, relating to that. Right. Thank you, Ravindu. Okay, good. So you have done that. Let's check your answer and it gives us 68. Yeah, just show me that. The answer 68. Yeah, let me verify that. Okay, good. Yes, you have done that. Perfectly correct. 68, 113, 405. Good. Okay. Now let's look at this. Fine. So Lakshita, so first tell me how you have taken this, the investment scrap, how you have taken the scrap value of the investment. Okay, you have taken it as a reference. So you have taken the initial one. Yes, good. So you have done it perfectly correct. Then the sales. So the first year sales, can you show us the first year sales? There you have taken this, the selling price and the demand. Good. Then most importantly, the second year onwards. So let's look into that. Right. So when you are taking this second year cash flow, yes, you have to make sure that you are incorporating the growth rate. So in fact, we've been discussing the questions of this nature, the couple of questions, even in the previous instances as well. So therefore, I believe that this was not a big problem when it comes to taking the cash flows. Yes, Ravindu, you have done it perfectly, and that is exactly the correct way of doing. So you would incorporate the selling price growth and the expected demand growth, right? So then you generate that and you can simply drag it, and you have taken that up until the 5th year. Good. Then similarly, we would like to see the variable operating cost, right? So there what you have taken the demand multiplied by the variable operating cost. Good. Then most importantly, the second year, okay. Similarly, you have incorporated the variable operating cost growth and the demand growth there, demand growth. Good. And then thereafter, you would have simply dragged that. Fine. Then how about the fixed operating cost? You can see that in this question, no changes to the, or I would say that no subsequent growth in this fixed operating cost. So therefore, you can simply take the value at year 1 and make it constant and simply drag them up until the end of the project. Good. Then we are coming to important point. It's about the corporate tax. So here, initially you have considered the sales, variable operating cost and fixed cost, and then you get a particular value, and on that it is in fact the cash profit in that you have applied the tax rate. And here the question had said that when it comes to the payment of this tax, you are paying this tax 1 year arrears, 1 year arrears. So therefore, the Ramindu has very correctly taken that the tax relating to the year 1, you must take it to the year 2. So consequently, the tax relating to the year 5 has shifted to the year 6. So the project, it says that it is for 5 years, but here necessarily you may have to recognize the 6th year. So that is what I wanted to test. I haven't discussed that particular thing in the video. I have taken an instance where the corporate tax is paid in the same year, but here I have tested you on that, and you have very correctly done that. Good.
Yeah, he has taken perfectly, right?
Yes, sir.
Ravi is very good. Thank you, Ravi.
Good job.
Yes.
Then we have taken on the tax saving on capital allowances. So I believe that when you are working out the NPV, this would be the one of the easiest way out. Or otherwise, if you haven't taken this particular approach, what happens is you may have to do a working, separate working, and identify the taxable profit and thereby take the tax. So it's going to be a time consuming thing. So you are working under a kind of limited time, especially in case of the examination. So therefore, you may have to look for some efficient ways. And in fact, that is one of the model development principles. So in line with that, so we have stick to this particular method. So we may compute the corporate tax based on the cash profit, and thereafter we may be computing a saving, the tax saving on the capital allowance. And here you have very correctly taken that. First you have taken the initial investment, and then you have taken the capital allowance, and on that you have compute the corporate tax, right? So here you can see that is another important thing. So the Ravindra has done it very correctly. Here the tax rate is 25%. So therefore you need to know that. So once you depreciate it for 4 years, that is all over. That is all over. So therefore you have very correctly stopped that in 4 years and taken that. So from year 1 to 4, when the depreciation is done, the asset is fully depreciated. So therefore you have to consider only 4 amounts. So in some cases, mistakenly, you can take even 1 more year. So if that happens, that is quite wrong. So therefore, pay special attention to this capital allowance. In some cases, it could be 20%. If that is the case, it would go for 5 years. But here it is 25%. So therefore, you need to know the depreciation, the asset would be fully depreciated by the end of the 4th year. So you have paid the due attention on that, and you have taken the saving very correctly, right? Yes, there's a question comes on. So why depreciation start from 2nd year? No, depreciation is not going to start on 2nd year, right? Depreciation would start from the 1st year, but remember, depreciation is something not relevant for this particular NPV computation, simply because depreciation is a non-cash item. But the only consequence what we would consider here is that when it comes to this depreciation, it is allowable to deduct when computing the taxable profit. So therefore, what you are looking at, the tax saving that you are getting because of this capital allowance, because of this depreciation. And that's what we consider. So therefore, this tax saving may comes together with the tax payment. For the year 1 tax, you would pay that in the year 2. So therefore, the benefit relating to the depreciation in year 1, and you must get that in the 2nd year. So in fact, what happens is you would be paying the net amount. Net amount is what you paid at the end of the day. So therefore, this tax saving is considered on the 2nd year. So ඒක තමයි සිද්ධ වෙලා තියෙන්නේ මෙතන උදා, right? ඒකට අපි ඇත්තටම capital allowance කියන එක NPV computation එකට අදාළ නැහැ. සරලම හේතුව තමයි ඒක non cash item එකක්. It's not a cash item. ඒතකොට අපි මෙතන consider කරන්නේ cash items. හැබැයි මේ capital allowance එහෙම නැත්නම් tax depreciation අපි දන්නවා taxable profit එකක් compute කරන වෙලාවක deduct කරන්න දෙනවා. එතකොට මේ amount එක deduct කරනවා කියන්නේ අපේ taxable profit එක අඩු වෙනවා. ඒ හින්දා අපි ගෙවන්න ඕනේ tax ප්‍රමාණයේ අඩුවීමක් සිද්ධ වෙනවා. එහෙනම් අන්න අපි tax saving එක තමයි consider කරන්නේ. එතකොට ඇයි අපි ඒක year 2 එකට ගත්තේ? මොකද year 1 එකට අදාළ tax එක අපි ගෙවන්නේ year 2 එකේ. එහෙනම් මේ benefit එකත් year 2 එකේ consider කරලා net amount එක තමයි ඇත්තටම අපි ගෙවන්නේ. ඒතර මෙතන අපි ඒක separate items විදිහට පෙන්නනවා. නමුත් at the end of the day what we may pay is the net amount, right? And that's what we have considered over here. So did I answer your question? Right. So you have done it very correctly. Then another important thing, it is about the tax on gain on asset disposal, or sometimes tax saving on the loss on asset disposal. So here, you know that the question says that at the end of the project, you are disposing this particular asset for a value. So it is in fact the scrap value. The scrap value we have computed earlier, and it was found to be like 20% from the initial investment, and it was computed as 10 million. So then at the end of the 5th year, you are selling this particular investment, particular asset for 10 million. Then at the point of disposal, you may have to consider whether there is a particular taxable benefit or kind of tax saving available. So in that, having considered this sales proceed, you may have to compare that with the carrying amount of the asset. What must be the carrying amount of this asset as per the tax depreciation, or as per the tax regulations? What is the carrying amount, right? In that, you have done the tax depreciation on an annual basis, and yearly it was 25%, and you have considered that for 4 years. Then you can see that at the end of the 4th year, this particular asset is fully depreciated. So therefore, if you take the carrying amount is going to be 0. It's 50 million per annum, 25%. So therefore, it's like 12.5 million, and that is into 4, it is 50 million. So therefore, the cost is 50 million, accumulated depreciation as per the tax guideline, 50 million, the carrying amount is 0 by the end of year 4. Then what you consider, that 0, the asset with the value of 0 is disposed for a value of 10 million in year 5, at the end of year 5. So therefore, this entire disposal proceed is turned out to be a kind of gain. So there's a gain of 10 million. So here we have the Ravindra has done it very perfectly. The first, Ravindra has taken the disposal value, that is G20, then has taken the what you call the carrying amount of the asset, starting with B3. So that is the cost minus the particular asset into the depreciation, into the number of years. Then there you have considered the accumulated depreciation. Then there you have found that the accumulated depreciation is equal to the cost. Thereby the carrying amount is 0. 0 worth of asset would be sold for 10 million. So it's entirely a gain, and you are going to apply the relevant tax. It is 30%. So in that, you would have witnessed, so there is a kind of tax that you may have to pay on the disposal. So therefore, it's a cash outflow. It is 3 million. And that is another important aspect. That is another important aspect. What you may do, and thereafter you have derived the net cash flow. Then working out NPV is nothing. So you may go to this NPV. So when come to the NPV, still you need to be conscious because you are not going to take year 0 cash flow. You would take the cost of capital and the net cash flows, and subsequently you adjust the year 0 cash flow. So in that you have witnessed the correct NPV. So here the Ravindu has done it very perfectly, and this IRR, yes, so it's just a matter of selecting all the cash flows. In that you have considered even the year 0 cash flow as well and taken that, and it was found to be like 64% or something, right? 63%. And thereafter I would have told you that write a particular decision rule considering this NPV and IRR, whether you are going to accept this project or reject. So here you have done that, but here what I have expected, in fact, what we have expected, in fact, consider both the test and write the one particular decision, right? So therefore you could have taken if and. You could have taken if and, consider both the thing and say whether to accept or reject. So shall we do that, Ravindu? Yes. You would have taken if and you would have taken and. So let's put them to the expanded form, then it would be easy. Just click on and you have to expand. Right, okay, good. The first test, you're going to check whether this is greater than 0. Okay. Then the IRR, whether it is greater than the cost of capital. Good. Then you can click on if, simply click on if. While you are in the same window, go and click on if valid there, over there. Right, okay, good. Then what is valid if true? If both these tests get satisfied, you are going to say that accept. And if not, it is reject. Good. So this is what I have expected. And yes, you have done it perfectly correct. So let's say that it is the decision in front of that. Like you have taken NPV and IRR, take a heading that is decision. Right, good. You have done it very correctly. Yes, now it's time for you to come up with the questions. We would like to add it. Thank you very much, Ravindu. You have done it perfectly correct. Yes, now it's time for you to raise the question. So this is what the Ravindu had done. Yes. So now we would like to hear, yes, okay. Why depreciation? Yeah, we have addressed that particular issue. Depreciation 1. We have considered, yes. පුතාට මේක ප්‍රශ්න තියෙන්න පුළුවන් අහන්න. ගොඩක් වැදගත් වෙනවා from your exams point of view. So you must be very clear with all the questions that you may have. Right, it seems that you all are fine. Right, yeah. Why we are always considering the effect of tax in the following year, sir? It's not clear. Okay, good. Why do we consider that in the following year? It is simply because it's a requirement of the question. The question had said that you are paying tax in arrears. You pay tax in arrears. That is, in the sense, tax relating to the year 1 would be paid in 1 year arrears. So you will be paying that at the end of the second year. And that's why we have taken the tax starting from the second year. But instead, the question had said that you pay the tax on the year in which it accrues. You should have taken that to the first year itself. But the question here, it had said that you are paying tax in arrears, 1 year arrears, right? That was the case.
Yeah, we are looking for a cash flow. So the cash flow activities are happening in the given date, right? So
Yes.
that's why we have considered that in the second year, because the payment is made in the second year.
Yes. Right. Good. So likewise, better you get the things clarified. So likewise. Okay. Now let's move on. Yeah. A couple of questions are coming, right? Considering the test marketing cost. So it is something that you should know from what you had learned in your second year, right? So why we should not consider this test marketing cost, right? In an investment appraisal, why test marketing cost to be ignored? So it was well explained to you in the second year, I believe, hopefully. It is simply because, you know, that when it comes to this test marketing cost, the benefits, you are not quite certain, right? So sometimes you would incur this cost, but you do not see a kind of direct benefit. So the benefit, you can't say probably there would be a benefit. So the benefits are quite far away. Benefits are quite far away. We do not know whether it generates some cash flows or not. So therefore, once you spend that, so that has to be expensed. So even you can look this from a financial accounting point of view. If this is to be something that you must capitalize, so be consider about the future probable cash flows. By incurring this marketing cost, you can't be certain that it may create some benefits in the future. So therefore, it is kind of irrelevant cash flow. It's a kind of irrelevant cash flow.
Question answers. Lakshita is having another question.
Yes, sir. Lakshita, yes, sir. When calculating tax on gain on sale of the asset, do we need to show it in a separate working, or can we include that in the formula itself? So what we would encourage is, it is better that if you can, if you incorporate that in the formula.
But if you work, if you are having the working also, we will consider that is no
Yes,
problem.
yes. In fact,
The
even
things
in
can be done.
yes,
So
even in
that,
my
like
case, I
he
have
is showing,
taken.
yes, yes.
So you
It
could have.
doesn't matter, but if you can calculate that with one formula, it is much more better, because that is the convenient way to calculate it.
Yes. So if you consider everything within the worksheet, the what do you call that output
Answer model,
itself, answer model, yes, that would be perfect. But even we consider if you had done something like this, but the only concern what we may come across that it could be time consuming even. So to go for a kind of arrangement like this, so it may take some.
May take a little bit time.
Yeah. So that's a concern. Good. Right. Yeah. Do we need to consider year 6 as well? Again, something in the similar situation. So when calculating NPV and IRR, do we need to consider the year 6 as well? Yes, if there's a kind of relevant cash flow, you may have to consider. So if I refer to the question over here, you can see that why we had to consider this year 6, that is simply because of this tax payment. We would pay taxes in 1 year arrears. 1 year arrears. So when it comes to the year 5th tax, we would be paying that on the year 6th. So therefore, even the question says that the project life is 5. So depending on the circumstances, you have to go for the year 6 for sure, right? Because the year 5th cash flows would be paid in 1 year arrears. So that's why we had to go for year 6. So it's most of the time because of this taxation. So we may have to go for year 6. But in some instances, we say that you would be paying the taxes on the same year. If that would have been the case, you may need not to consider year 6. But it depends on the question. So therefore, you need to carefully read that and apply what it had specified. In this question, it says that the project life is 5. But however, when come to the answer model, you can see that even the year 6 is there. So it is simply because the tax is paid in the next week, right? Good.
And we are evaluating the whole project.
Yes. So you have to consider the whole project. It has not taken the year 6, I guess. Okay. Let me check that. Good. Good observation. Yes, it says that I haven't considered the year 6. Good. So it is from year B7 is there. G, yes, very correct. Thank you very much. So I haven't considered 1 year. No? So let me please select that. Yes, you have to select the entire thing and say okay. Yes, it comes as 62.79. So you have to consider all the cash flows in IRR. In fact, I have missed that. Thank you. Good. Right now, let's move on to the, what do you call that, the loan amortization schedule. So again, we would like someone to contribute. So now you can share the screen. So without taking much time, we may do that. Right, okay. Thank you, Roshana. Right, if I look at the question says that on 1st of April 2019, the Pedrick Private Limited obtained 1 million loan at an interest of 18%. You have identified the inputs. The loan should be repayable in 5 years in equal installment. Okay. Then it says at the end of the lease term, the Pedrick Private Limited wants to have a saving of 200,000 in the bank. Okay. So you have identified that as well. Then the question requirement, first calculate the value of an annual installment. Okay. So can you show that? How you have compute that? Yes, you have very correctly compute that. So let's put to the expanded form of the formula and let's see what are the inputs that you have made use of. Okay, put that to the expanded form, right? First you have taken the rate, good, the annual rate. Then the period you have considered, it is 5, the present value, good. And most importantly in this question, again, this is a little bit different from what I had, the questions what I had discussed. Here I have asked you at the end of the loan period, you need to have a kind of saving. So let's just remove this fair value and see what is the situation. So can you please remove that and show us? So you can see that whatever the installment what you may have to take is lower. But if you expect to have a kind of saving, then as a result of that, the annual installment would be much more higher. So if you incorporate that, you can see, take the fair value, so the future value, take that. Yes, you can see that your annual installment is turned out to be 347,733. So that is the important change that you need to observe, right? So if you just paying the loan,
we also explained to them that type already explained what do you mean
yes,
by
yes. Yeah, we may emphasize that as well. Yes.
Yeah.
Yes, as Kalum sir had mentioned that, let's go to the expanded form and let's see that particular thing as well. So can you please expand on the formula? Yes, here also, what about the type? So in fact, we have discussed about that, but we haven't tested. So when it comes to the type, again, if you simply ignore that, you can see the description, the payment at the end of the period.
Or the beginning period.
Yes. So if you take 0 or omitted, then it assumes that you are making the installment in arrears or at the end of each reporting period. But if you make,
if you paid this in the beginning of the year or the month, then it will come down.
yeah,
Not the same value. So if you type there 1 putta, then you can see that.
yeah, we may see that. So can you please type 1 and see what is happened? Yes.
Then you can see immediately the value come down because it is paid in the beginning of the month.
Yes. One of the most important aspect there is, if you pay at the beginning of the period, simply no interest component would be there in the first year. You would witness that. So we'll be looking at that. And thank you very much, Kiran sir. Yes. Right. Thereafter, you've been asked to compute the monthly installment. You have taken to the monthly installment. Let's put to the expanded form. This is also an important thing. In most of the circumstances, we have seen, even in case of the examination, when you've been asked to compute the monthly interest rate, you mistakenly ignore the conversion of the rate into a monthly rate.
Yes.
You are given the annual rate. Here, that is annual rate. So therefore, it is very important to divide it by 12. Then only you would get the monthly interest rate. So convert that. And also when it comes to this, the period, again, that is something that you need to be conscious. Normally how we do, so let's change that a little, Roshana. So go to this period. So just remove that. And normally how we do, you would take the number of years as you typically have. You would get the number of years,
multiplied,
then multiply them by 12 in order to convert that into the months, right? Earlier you divide and here you multiply. So you have to very carefully, consciously do this, perform these things, right? And then you take the future value, yes, very correctly taken, and the present value, and then the future value. So here we have assumed you will be paying at the end of the month, so therefore we have simply ignore this type. Then you could say okay, and take us to the bottom. Take us to the bottom of the loan amortization schedule. You have start with opening balance, interest, installment, capital repayment, and the closing balance. And if you go to the end of the loan amortization schedule, you can see that there's a saving of 200,000 is there. There's a saving of 200,000 is there. So as we expected, the saving is there, right? Good. So you have done it very correctly. Thank you, Roshan.
If the saving is not there, we need to get a zero value at
Yes.
the end.
Yeah. Yes.
If the NC savings are not there.
Yeah, let me share that. Yes, if the savings was not there, so it has to be 0. It has to be 0. So let's just remove that and see. So when come to these installments, so I would remove this future value. And also in the interest, I would do the same. Future value must be reduced. Sorry, would be eliminated. And even the capital repay, I can eliminate this future value. Say okay. Now if I simply drag them down, so let's see what happens. You can simply double click that, then it will take up to the bottom. Then here you can see at the end, this had become 0. So you have fully paid the loan once you settle the 60th installment. Once you settle the 60th installment, you have fully settled the loan. So here we have assumed that you need not to have a kind of saving, but just to repay the loan. So if that is the case, so this is what you would have paid. And so I have taken one important instance, that is to further highlight the fact the Callum sir had raised. So when it comes to this, so we have discussed more instance about the payment of loans at the end of the period. But what about the instances where we may settle the installment that we take the option to settle them in advance? So at the beginning of each year. So here I have taken an instance. The loan is taken as 1 million and the period is 5 years and the interest is 18%. And let's go by the annual installment. Here we have the loan outstanding at the beginning of the period. Here I have identified the installment and then the interest. Here we have the interest and the capital repay. Capital repay, and finally the balance carried forward in the loan. Right. So here we can see. So when it comes to the installment, so you would take the rate, you would take the period and the present value, and most importantly, we have taken this time. So if you had ignored that, what happens is you can see that your installment is going to be quite high. It's 319,777. But if you take the option to settle at the beginning of the period, it comes as 270,998. Then the installment would remain the same. And most importantly, since you pay the installment, the first installment on the very first day, there's no interest component is there. This is one of the main differences what you would see. So compared to the previous one, it's quite obvious one, but just to highlight it, and this is it, right? Then at the end of, or even I would say at the beginning of the 5th year, so your loan outstanding had turned out to be zero. So that would be the instance. So that's what happened if you take the option to settle the loan installment in advance. Right. So this was what the expectation, and I would like to go to the one of the concerns that you had raised. It's about the if errors, if error function. In fact, that is something that I have investigated after raising the concern in the last concern. So one of your friends had raised a concern that can't we use this if error, and thereafter I have explored that and found that it works. So now I would like to share that with you. In fact, I have shared the answer. It was there, but just to show you how to work that out. Let me get that in some time. Let me simply download that.
And also, Lakshita, we have already uploaded 2 videos regarding this multiple IRR. So you can watch that and see whether it is appropriate to get your answers for the question you asked. Right?
So in fact, all these concerns, what you bring that, even that would help us to look for more insights. So it is really encouraging, and so we will ask you to continue this practice. So it will benefit each and every one of us. So let me get the answer from the LMS. In fact, I had uploaded that in the last class. Answer continue. So when we were computing the discount when we compute in the commission tree using the ifs function in the last class, what we had observed is we have observed something like this. It was one of the limitations what we had observed. So if I just take back to the original situation, it was something like this. So we have seen that in the instances where this formula is not applicable, so there they have given us the not applicable. And we found that, so by using the nested if, we could have overcome, that was one alternative, but even we have looked for another way out, which is comparatively easy, compared to the nesting if, and that was the ifs function. But when we are applying this ifs function, what we have witnessed that we have seen that the not applicable comes. So it is something that we need to eliminate. So if you have to do that manually, it's not going to work. So definitely it will take more of your time, and it's not going to work. And then the suggestion came from one of your friends that can't we use if error? So in fact, I have tried that and even it worked. Then how you must apply if error for a situation like this? When you have this entire formula, so you have to go to the beginning of that, and you have to take this if error. You can insert if error there. See, once you type that, if error comes. Then thereafter, you can go to the end of this formula, and you can take a kind of comma, and you can specify. Yeah. So just need to check that. Yeah, we need to put 0 there. We need to put 0 there. Sorry, we need to put 0 there and close the brackets. And if you enter, yes, you can see that now you can easily eliminate that. And this is how we apply the if error. So if error is there, you may take it from the beginning, and then you have the if function or whatever the function that you have, and thereafter at the end you would give 0. So once you give 0 for the not applicable instance, it gets replaced by 0, and that's what happens over there, right? Okay, fine. So you may explore this further, right? So Callum sir,
I think everything is discussed related
yes,
to the today's lesson.
yes. Now it's time for us to discuss about our class assignment. So our case study. So as per the course outline, we have planned for two case studies. So therefore, now it's the right time for us to go for the first case study. So so when it comes to this case study, so we have observed that over the years that the participation is quite less. Even we have highlighted in a couple of times that, so we would expect a higher participation. Even the fact was highlighted by the head of the department as well. So therefore, we believe those who would participate for these lectures, so should definitely get a benefit out of that. So in that light, we have decided to have your first class assignment today itself. The first class assignment today itself. So accordingly, so you would need some break, and then allowing you like 15 minutes to 20 minutes break. So we are going to open up the class activity, sorry, the case study at 9 p.m. today. And as far as this case study is concerned, so it will carry 10 marks. And also you can manage this within 45 minutes, and you would be tested on the aspects what we have discussed so far. So therefore, it is based on the online discussions that we had in the class. So you can very easily manage that even within 45 minutes. But considering the issues what you may face during this uploading, we have allocated 15 minutes for that. So then altogether, we would expect you to upload this answer by 10 p.m. today, right? It opens at 9 p.m. and it gets closed at 10 p.m., right? So we may do accordingly. So in 15 minutes time, we are going to active your first case study. So you have 1 hour's time to complete and upload it using the given link. Callum sir?
So that's okay, I think. So we'll then we will conclude and give them a break.
Yes.
So then at 9 we will open up. Then they can do the activity and upload that before 10 o'clock.
Right. Yes. Sure, sir.
Yeah.
Right. Okay. Then with that note, so let's stop the discussion. Thank you very much, sirs.
Okay. Right. See you.